In a downtrend, you will first see a long bearish candle. The next candle will open much lower as price gaps down, but will form a big bullish candle closing equal or close to the previous candle's close. This is the bullish meeting lines candlestick pattern. The idea is that in a downtrend, the selling pressure creates the first big bearish candle in our pattern. This negative sentiment ends up forming a gap at the open of the next candle, giving the bears confidence that they're still in control. However, some buyers sense price has dropped too fast and too low. Time to step in and counterattack. Price is pushed all the way back up, closing the gap and closing at the exact same price as the previous candle, or at least very close to it. The fact that the bulls were able to do this could mean a potential reversal ahead. In an uptrend, you will first see a bearish candle, followed by a bullish candle. This second candle will gap up, opening above the body of the previous candle or right at its open. The second candle must close higher than it opened. This is the separating lines candlestick pattern. The idea is that when the bulls are dominating the market, the bears temporarily take control, causing concern for the bulls. However, when the second candle gaps up, opening at the same price or above the open of the previous day, confidence is restored in the bulls as they jump back in and drive prices higher. Okay, so there's two candles in this pattern and it will happen during an uptrend. So the first will be a bullish candle and the second will gap down but will also be a bullish candle. However, this second candle will not be able to close above the close of the first candle, but instead will close at the exact same price. This is the matching high candlestick pattern. The idea is that during an uptrend, there's a fear that the market has become overbought. As traders then begin closing positions and locking in profit, this can cause the market to gap down. But when recovering from this, but then being unable to close above the previous close, signals that the market sentiment has become more bearish and that there could be a potential of a reversal into a downtrend. In an uptrend, you'll first see a big bullish candle, followed by three small spinning tops. The second candle opens higher than the close of the first, creating a gap. Finally, the fifth candle will be a large bearish candle closing below the prior three candles and in the gap created by the first two candles. This is the bearish breakaway candlestick pattern. It signals that even though the bulls are pushing price up with big bars and price gaps, the small spinning tops indicate they may be losing control. The fifth candle suggests that the bears have taken control, but as the initial gap is not filled, it will be the next few candles to really confirm whether a reversal will occur into a downtrend. In a downtrend, you'll see a series of bearish candles, and they will be met by a bullish candle. This bullish candle's opening price will be the low for the day, and will open lower than the close of the previous day. It will also close well into the body of the previous candle. Furthermore, it will have a very small upper shadow and no lower shadow. This is the bullish belt hold candlestick pattern. In a downtrend, the first candle will be a big bearish candle closing near its low, followed by a bullish candle where price gaps up, opening and trading above the close of the first candle. Finally, the third candle is bearish and gaps up, eventually closing at the same price as the first candle. This is the stick sandwich candlestick pattern. It is a bullish reversal pattern, and if price goes on to break the high of the third candle, there could be a potential reversal into an uptrend. The idea is that the first candle tests new lows, but the second candle opens and gaps higher, indicating to sellers to be cautious. The fact that the third candle also opens higher and can only close at the same price as the first candle could signal a significant level of support. First, you'll see a big bullish candle, followed by at least 2 to 3 small bodied candles, usually in the form of spinning tops or small dojis. Finally, to complete the pattern, a big bearish candle. This is the tower top candlestick pattern. It signifies a bearish trend reversal as buyers exhaust their momentum to drive price up any further. As price moves sideways, sellers begin to step in, and the formation of the big bearish candle indicates that they have now taken control. In an uptrend, you'll see this occur between two candles. It is a price gap between the first candle's high and the second candle's low. This is the rising window candlestick pattern. The way it works is during an uptrend, a market correction will stop at this window, which means it is essentially becoming a support level. If price cannot close below this window, it signifies support against any selling pressure. In a downtrend, price will begin to move sideways, forming a concave pattern. You will see lower lows, then the same lows, followed by higher lows. It indicates that bears are losing control and signals a possible reversal from a downtrend to an uptrend. But what gives confirmation of this pattern is that the market gaps up after this sideways movement. This is the fry pan bottom pattern. In a downtrend, first you'll see a bearish candle, followed secondly by a large bullish candle. A key thing here is that price has gapped up before forming this big bullish second candle. This is the kicker candlestick pattern. It is considered one of the most reliable reversal patterns due to its sharp reversal and can point to a change in investors' attitude. In a downtrend, you'll see the first candle, which is bearish, followed by the second candle, which is bullish. This second candle will have gap down, opening lower than the close of the first candle, and then close above the midpoint of the first candle. This is the piercing candlestick pattern. When technical indicators such as the RSI are showing bullish divergence and we see an appearance of this piercing pattern, it could signal a potential reversal and buyers are getting ready to take control. The first candle will be the same as the overall trend. So if the price is moving down, the first candle will be bearish. The second candle will be the opposite of the overall trend. So as before, if price is moving down, the second candle in this pattern will be bullish. Another characteristic is that the wicks of the candle should be equal or near equal length. They should also have the same lows. This is the tweezer bottoms candlestick pattern. First, a large bearish candle, followed by three small body bullish candles that trade within the high and low of the first candle. Finally, a bearish candle that breaks the low of the first candle and also closes below this low. This is the falling three methods pattern. First, you'll see a series of bearish candles creating lower lows, and then all of a sudden we see this. Now the first thing to pay attention to is the market has gapped down, but the sellers are not around to drive down price further, which is evident by this candle, a small range doji, which shows that this bar opened and closed at the same price. Now after the doji, the next thing will be a bullish candle, but pay close attention here because as you can see, the market has now gapped up, and this completes the pattern referred to as the abandoned baby. First, you see a big bearish candle. Second, a small bullish or bearish candle. And third, a bullish candle that comes up to at least halfway of the first candle.